It's a whole new world, and we just heard something very interesting in this crypto space. But now we're going to do something a little more traditional, from crowdfunding to IPO. Take your company from crowdfunding idea to an IPO, learn what it takes to go public with Reg A. Now, when I first heard the words Reg A, I thought of music. It never occurred to me that it was a regulation. Anyway, Brian Korn will be your moderator, and Jason Paltrowitz will be here, Joan Dromey, Michael Cullen, and Steve Yakubov. So if they could come and take their seats, and we'll welcome them with a big round of applause as we continue here on Crowd Invest Summit 2017. It's great to have you all here. Please welcome them with a big round of applause.
Is this on? There we go. So we heard this morning a lot about cryptocurrencies, new technologies, $200 million raised in 60 minutes. And it's obviously very exciting, very fascinating. And where we come in is on how you actually do a deal like that. And not only how you do deals with coin offerings, which really would only apply to a company that's able to develop a unique token technology, but to ordinary companies, to other ideas, corporate ventures, and other transactions where you're looking to raise securities, but you don't want to end up in jail. And that's really the goal here. Raise capital, stay legal, avoid litigation, avoid regulatory headaches. And I have a great panel here now where we're going to discuss what the various options are today about raising capital in the current environment from a legal and a technical perspective, and things you should be thinking about if you're looking to raise money in whatever context it is and how you do that legally. My name is Brian Korn. I'm a partner at Manat Phelps in New York. I specialize in digital finance. We do work on a lot of cryptocurrency and ICO transactions, but we also do a lot in the marketplace lending space, in the crowdfunding space, and basically what you can sell, where can you sell it, and to whom, and with what materials. And we're going to talk a little bit about what are the issues, the main issues you need to think about when you're going out with your first offering, and who you should sell it to, what materials you're going to use, and who's a likely buyer of this stuff. I have with me a great panel. I'll let them introduce themselves and tell you a little bit about what they do. Joan?
Is this working? Okay, good. I'm Joan Dromey. I'm the Senior Product Manager for the Private Markets Group at ComputerShare. ComputerShare is the largest SEC-registered transfer agent in the U.S. We've mainly done record keeping for publicly held companies up until about 3 or 4 years ago, and we kind of made an official group a couple of years ago. We do a lot in the Regulation A+ space, have done very little with Reg CF, and we do handle a lot of IPO work as well. And we do the unsexy stuff. We keep track of who owns what. But if you had bought 100 shares of Facebook way back when, you'd probably want to know that that was well kept track of when it actually went public. So although what we do isn't particularly glamorous, it's both necessary from a regulatory standpoint if you're doing a Reg A+ Tier 2 offering, and it's also nice to have an independent record keeper, and that helps you communicate with your investors and have some transparency, because if you're going to be a public or even semi-public company, that becomes an important factor.
Hi, this is bright lights. My name is Jason Paltrowitz, Executive Vice President of Corporate Services for OTC Markets Group, the home of OTCQX and OTCQB markets, where over 10,000 international and U.S. securities trade. We are the proud home of the first Reg A+ deal that closed. We're also the proud home of the first Bitcoin trust that went public, and a number of other crowdfunded, innovative security types that, for myriad reasons, not the least of which is the cost and complexity of a national exchange, choose to use our markets to list their securities, to have a regulated public market with liquidity where investors can buy and sell those securities.
Does that work? All right, much better. My name is Miguel Colon. I'm the president of a company called Transferly. We built a back-end platform that powers the closing process of a Reg A plus or even a Reg D transaction. So whenever you see the Invest Now button or click here to invest buttons, that's really what our company does. We built the platform about a year ago. We've closed about a dozen transactions. We've got probably another dozen and a half that are at various stages. Prior to starting Transferly, I'm also an entrepreneur. I've started 7 companies, all prior to Reg A+, which means that I either had to make them work or sell them. So I've started 7, sold 3. And so when we start talking about Reg A+, sort of the entrepreneur in me gets very excited at the prospect of being able to raise money, not just from the wealthy, but from everybody else as well.
Hello, my name is Steve Yakubov. I'm the president of Edgar Agents. We are a financial printer and SEC filing agent. We assist companies with their regulatory application filings on Edgar with SEC. We convert the documents into a proper format that's required by SEC. We file those documents, and we also print. We print prospectuses, annual reports, proxy statements for companies who are public. We're among top 7 most active SEC filing agents in the nation, and we've also processed tons of Reg A+ offerings on Form 1A. We do Form D filings, Form CF filings, and 24/7 operations. We have clients all over the world, and that's what we do.
Great. So, it's interesting to hear a lot about the, from the entrepreneurs and from the people who are leading the charge from the company's perspective. What you have here is sort of, here's how you do it, here's what you need to do, and here's who you need to know. I'm going to give you guys 5 minutes of quick context just so that we're all on the same page, because I'm not sure of the background of everyone in this room, but we throw out terms like Reg A Tier 2 and 506C and 4A2 and Reg S, like everybody knows what they are. I will give you a quick tutorial so that you can walk out of here feeling like you now have a much better toolkit on what these things are. So capital raising in the U.S. until 2012 really took 2 forms. On the one side, you had public offerings, which included IPOs. It included publicly traded securities. You buy a share of PepsiCo or Walmart on the New York Exchange. Those are publicly traded securities. There is no qualification for that other than having enough money in your brokerage account. Your broker has to do a suitability review, and you can buy those shares and have them in your account in milliseconds. It still closes on a T+3 basis. The other side of the wall are private placements. So these are securities that are being sold to people who are sophisticated investors or accredited investors, we call them. They generally are startup capital, startup funds, VC funds, hedge funds, other types of private company raises and private capital raises. Those are all done in the private placement world, not the public offering world. The biggest difference between a public offering and a private placement is that a private placement has to go through the SEC and get qualified or effective, and that involves a detailed comment and response process, usually a 3 to 4 month back and forth or longer with the SEC on your disclosure document, which can be many hundreds of pages. And at the end of that, you have the reward of being a public company, which means you have quarterly financial statements, you have to file annual reports, you have to have an annual shareholders meeting, you have to have 3 designated committees: audit, corporate governance, and nominating committee. You have to have 8K filings, which means that you, anytime one of 50 or so events occurs, you have to make a filing within 2 business days. You have to control the trading of your board and your officers. You cannot have opposite weight trades among those people within 6 months. Anyone who owns more than 5% of you has to file something called a 13D or a 13G. So being a public company involves a lot of infrastructure and a lot of work, and it was really only for companies that had the capital and had the wherewithal to do it where it made sense. Being public involves many benefits. You have a currency for your employees to trade out of their positions. You have a way of raising capital for acquisitions and capital infrastructure and improvements. But the costs involved are also very steep. And so for small companies that have very little resources, an IPO is not something that's advisable. So in 2012, President Obama signed something called the Jobs Act, which is the Jumpstart Our Business Startups Act. This is actually him signing the Jobs Act. We go back in time to a different president. Behind him is former Majority Leader Eric Cantor and Steve Case, who pioneered the Jobs Act. To the president's left, looking down, is Congressman Patrick McHenry, who's still very involved in capital raising activities. He's a congressman from North Carolina, but he and a handful of others on the Financial Services Committee really lead the charge for crowdfunding for things like Reg A. So what did the Jobs Act do? Well, the title was to increase American job creation and economic growth by improving access to the public capital markets for emerging growth companies. The Jobs Act had 4 big components. Number one, something called the IPO on-ramp. Allowed companies less disclosure, allowed them confidential filings with the SEC. You could go public more easily, more quickly than you could before if you wanted to do an IPO. 2, private placements. You now have 2 types of private placements. You have the traditional private placement, which is done to accredited investors, and you now can have a solicited private placement, which sounds like an oxymoron, but you can now solicit your private placement to accredited investors only, as long as you take reasonable steps to verify that they're accredited. The third thing was crowdfunding. When we say crowdfunding, we're talking about public crowdfunding, Title III, which is now codified as Regulation CF. This is the law that allows you to reach out to investors without an SEC registration statement, but you can still go to both accredited and non-accredited investors alike. An accredited investor, by the way, is somebody who has $200,000 of income, or $300,000 for a married couple, or $1 million of net worth, or a company or a corporation with $5 million of net worth. The SEC estimates that about 92% of Americans live in non-accredited households, and so that's a lot of people who are on the sidelines, not a lot of capital, but a lot of people who are on the sidelines of the capital raising process until the Jobs Act came out. Crowdfunding promised to democratize this process by allowing people who are not accredited access to companies before they go public, pre-IPO capital raising, without SEC registration, without the review process, and you could do it under this crowdfunding rule. Now, the sort of the older brother to crowdfunding is something called Regulation A+. The SEC changed something called Regulation A, which was a small offering exemption, which allowed you to raise up to $5 million from non-accredited investors. It said now you can go to $50 million, and it broke it into 2 groups, Tier 1 and Tier 2. Tier 1 allows you to raise up to $20 million. You do not need an audit. Tier 2 allows you to raise up to $50 million with an audit. The advantage of doing a Tier 2 offering, and that $50 million is a renewable every 12-month offering. The advantage of doing a Tier 2 is that you have something called blue sky preemption, which means you do not have to go state by state and ask each state if you can also offer the securities. You have that locked in with Tier 2, but not Tier 1. So those are the 4 big issues within the Jobs Act that we're going to talk about. IPOs, private placement reforms, what I call the 506B, the traditional private placement, 506C, the advertised private placements, crowdfunding, which is Reg CF, and then Regulation A+, which is between crowdfunding and an IPO. It's sort of the early stage IPO, and that's getting a lot of attention. We're going to talk about it with our panel. I have here a chart that I'll leave up for a few minutes that sort of compares all of these options so that you can see what's what. Early stage companies where the founders get together and put money in, even if they're not accredited, that's still allowed under something called 4A2 or 4.2. It used to be, which is essentially that sophisticated investors in a limited offering can still pool capital, and that's not something that has to be done with accredited investors. So you're wondering how a lot of these startups were able to raise money from themselves. That's part of that as well. So I'll go to the panel now. I guess, Joan, I'll start with you. How has the Jobs Act changed what ComputerShare does and what your job is? What are the different complexities that are now involved in dealing with companies at various stages of the capital process?
Well, I think what it has changed for us is from an operational and product standpoint, These are smaller companies, so we had to design a product that was flexible enough to meet their needs. And because they're smaller and less well-capitalized companies than some others that we deal with, let's say AT&T and Ford and Walmart, it's a different viewpoint that the company takes. They're concerned about their costs, they're concerned about how they're going to grow and make their business run. So we basically designed a product where it's kind of a la carte. So based on what the company is doing, we can configure and design what services they might need. One of the things that I've seen in the last 2 years is there are more companies doing this, but almost everyone that I've had contact with, this might be their first offering or maybe their second offering. So we have a lot of what I'd call novice issuers. That means that sometimes people approach us too early. They'll say, well, I'm thinking about doing a Regulation A+ offering and I hear I need a transfer agent. It's like, well, you probably don't need one yet if you haven't filed or you don't even have an attorney. So not infrequently, sometimes I find myself in the position of, do you have a good securities attorney yet? If not, here's a list of people you should consider talking to depending on where you are, what your budget is, and what you're trying to accomplish. So I find that people are trying to assemble what they need, and they want to partner with people that have done this type of work and have expertise in it. And for us, I mean, record keeping, we count a lot of different varieties of beans. And the beans need to be counted, and they need to be counted accurately, and companies go through different processes. Companies that are going Regulation A+ are not typically what I would call startups. They're usually companies that have more than an idea. They have a product or they have a service, they have a business that has some sort of track record. And now they're looking at ways they can expand and grow that business without, and going back to what you were saying before, when we did the research on starting this group within ComputerShare, I looked at a lot of SEC data, and one of the most interesting things in it was the SEC itself estimates that the cost of regulatory compliance for companies to comply with Sarbanes-Oxley and Gramm-Leach-Bliley and Dodd-Frank and so forth, it averages $3.4 million a year per company. That's a lot of money if you're a smaller company. So the Jobs Act allows companies to fly under a lot of that radar and have lesser reporting requirements. I wouldn't say the compliance standards are necessarily lesser, they're just different and don't have as much cost outlay. So for many companies that we're dealing with, this is a new landscape, and there's a lot to learn. There's that whole ecosystem of how am I going to market my investment, how do I do that in a compliant manner, and then now that I've got all these investors, oh Lord, what do I do with them next? Because investors expect if they turn over their money to you, they want to have visibility into their investments, and they want to have some degree of transparency about what you're doing with their money and your company. So there's a cost when you acquire other people's money and you put it to use. You have a built-in cost in servicing that, and it's a cost that you'll incur every year, just like with reporting requirements. And what I find is sometimes issuers aren't prepared for budgeting for that and understanding that they're going to incur these costs, whether it's with the broker-dealer, the underwriter, the transfer agent, whoever it is. You've now got this entire ecosystem to feed the investors that feed the capital that makes your company run.
So when I was doing IPOs, when I started my career in the mid-90s, every deal would be done through paper certificates until it was ready, until you're ready to go public. And then there was a question of, let's pick a transfer agent, who's it going to be? And then there's a huge process of marshaling all the paper that may have been dispersed to shareholders or maybe in a single binder, getting it in your hands so you can create something called a book entry ledger, and somehow qualifying that with DTC, which is the master operating system that controls.
That's a whole nother ball of wax, and that's something that occurs too. I have a small soapbox that I pull out to talk about the evils of paper certificates. Unfortunately, one of the things that I see is a lot of companies that have done a couple of rounds of financing, they have paper certificates. Sometimes they've been smart enough to have their attorney hang on to all the certificates. But as you look at how you're going to grow, facilitating things like going to the OTC market or going onto an exchange, paper certificates are the last thing that you want. Unfortunately, most companies already have some floating around. So it's important to take things like that into consideration as you look at how you're going to move to where you can gain some liquidity for your investors.
So Miguel, I guess sort of same question. How has the Jobs Act changed how people in your role now deal with capital raising?
It allowed us to be born. One of the things that entrepreneurs quickly discovered is that raising money requires a lot of documents. So you create a whole bunch of those documents, right? The legal documents, and then there's subscription agreements. You require signatures, and we quickly discovered that in an environment where I might be introducing myself to Jason and convincing Jason to invest, it's easy because I can hand Jason the paperwork, he can fill them out, write me a check, and we're done. But in an environment where I'm sending out 5 million emails, or I'm running ads on Facebook or Twitter or Instagram, and people are clicking, I can't then say, well, I will email you the subscription agreement, please fax it back to me. And so this created the environment for Transferly to be born. And so our platform, what we tried to do was to mimic the existing process that was in place. So that some of our competitors, they try to be sexy. And to be honest with you, every lawyer that we've spoken with, they get very, you guys are not excited about sexy. Let's admit it, right? And so we tried to create something that was efficient, something that worked and that mimicked the process that everybody had respected for the last 100 years. And but take it and put it into an electronic world. And so what we're seeing is that it creates a much more simple environment. So you can close the deal faster. If you, the fastest transaction we had close was VidAngel, 9,700 investors in 28 hours. And I don't think they had fax machines that were fast enough to process that many subdocs. And so this really just sort of created an environment where we could be born and take what had historically been a fairly inefficient process and make it really, really efficient. And then you take those documents, and whether you hand it off to Computershare or to one of the other transfer agents, you've got the record keeping going forward is so much easier because everything has been captured electronically. It seems like a no-brainer, right? But if you roll the clock back 10, 15 years, there was a lot of paper moving back and forth.
Now, let me ask you that. So what I liked about print, PDF, and fax back is that it at least forced somebody to do the action of turning a page to at least, at a bare minimum, find where they're supposed to sign. And maybe they read a few lines, or maybe they read the whole thing. We're now in an age with most sites where we have something called an Invest Now button. And in many of these sites, you can invest within 10 minutes or 5 minutes of creating an account.
45 seconds
right.
is about what our average is.
I have clients call and ask or email or text, can I put the PPM in the terms of use? Can I have it be a click box disclosure where we have a 50-page document that has 30 pages of risk factors about how the offering will work. I mean, many of you, if you follow the Filecoin ICO 2 weeks ago, they had a disclosure document, which I'm sure nobody read, that said that wasn't even an offering of tokens. That was a simple agreement of future tokens, a SAFT agreement, which their prime risk factor was that they may not ever make tokens or deliver any tokens. And you're basically funding a startup to engage in this tech journey, but you're not actually buying equity in that company. You're buying a token. It's like if you're investing in American Airlines, to use one of their sponsors, and you're bidding higher and higher amounts for advantage miles that may not ever be worth anything because they might expire, or you may not be able to use them when you want to. It's not an investment in the business. And so what I fear is that the bearing of a lot of important disclosure into terms of use, into click boxes, into click to agrees, that does, I think, take away from the message. And what most of my clients will do at our advice is to have a hyperlink to the disclosure document on the page somewhere, so at least somebody who is interested can go in and look. But I agree that the advantage of being efficient and technologically quick does take away a little bit from the thought process that people should be going through.
There's no question. It's interesting to be on these calls where we've got the marketing company and the entrepreneur, and the marketing company is trying to do their job and remove all barriers. The marketing company would like you to put in your name, I'm Todd, here's my bank information, click, right? And the lawyer's going, whoa, 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 we really should be doing this and we should be doing that, and what about these verifications? And so there really is this battle that takes place between the entrepreneur and their marketing company to a large extent, who don't necessarily understand the regulatory environment. I mean, we've been part of some conversations where we expressly said you need to get counsel on the phone because what's being proposed is illegal. And we're all over pushing barriers, but I think you started by saying part of your job is to not go to jail. And so there really is this push back and forth as people are trying to gain more efficiency in the process and speed it up. At the same time, the lawyers are saying, we need to slow it down because the investor needs to understand what they're really getting into, or maybe next year we're going to have somebody up here talking about shareholder lawsuits and shareholder activism, and we're not talking about that yet. But if sometimes you don't slow the process down, you really open yourself up to bigger issues.
So Steve, I wanted to bring you in. If we take sort of the full range of the process from the two founders putting money into crowdfunding, Reg A, IPO, Edgar filings, explain what Edgar is, why we need to do Edgar filings, and why use an agent versus a printer or versus getting your own codes.
In 1996, SEC came up with the Edgar system. It's an electronic data analysis system so basically they mandated companies, instead of doing a paper filings, now you can file it publicly. Electronically. But you can't just save your offering statement or a Form 10Q or a Form 10K in a Word or a PDF file and send it to SEC. It doesn't work this way. They came up with their own language, and they said you can, it used to be a text formatted documents, and now it's, HTML documents. And you have to take those documents, you have to take the native files and convert to the SEC required formatted files. And that's where the SEC filing agent comes along. Any document that gets filed with the SEC needs to be converted, whether it's a registration statement, the Form S1s, IPO, or a Reg A plus offerings. They need to be converted and filed with the SEC. The advantage of using a filing agent is, first of all, it's expertise, 24/7 support, and it's a deadline-driven industry. You always, on a daily basis, you have deadlines. You need to file by 5:30 p.m. to get today's date. When the annual reports come in, the quarterly reports come in, they also have deadlines, and you need to file on time. So you do need expertise to file the documents, to convert them properly, and at the same time, it's all about the platform, because when you convert the documents and you get the Edgar output, you also, when it comes to the registration statements on IPOs, you also need to generate a typeset file that will get printed, because once you file S1, once you file an amendment, you might have a roadshow by next morning, so the same document that you file with SEC has to go into print at night and get, be ready by the morning, so it gets to the deal people. So it's the whole single source platform that the filing agents and financial printers have that enables this type of an output. Also, it keeps track of all the changes that the working group makes, and we're able to produce the change page only proofs, the cumulative proofs, the current proofs, and these proofs, they help expedite the review process of the working group, and also you submit the cumulative proof to the SEC examiner that can see where actually changes were made from one amendment to another, and it helps expedite the review process as well.
Yeah, so Edgar started out as something that was really a genius, way ahead of its time. There were paper filings done for a while, not a little bit before I started working. People would get on the Amtrak from New York to make a filing at the SEC in Washington in their offices and try and get there by 5:30 and get that file stamp copy. And sometimes you go in the archives, you can still see these file stamp deals. The Edgar process was revolutionary because everyone had access instantaneously. Now it seems a little bit antithetical, because why can't you just file a piece of paper with the SEC, or why can't why go through this process? But I think part of it is the SEC wanting to have people who know what they're doing in the controls and make sure that filings get put in the right format.
Yeah, because if you file your document in a PDF format and a Word format, those are private applications that cost money. So what if public has no access to those applications to review the document, to read the document? So it's not public anymore. It's not available to everyone. That's why SEC came up with this requirement that it needs to be filed in a certain way, so everyone has access to it, and you don't need to buy any third-party software to view those documents. And it still stands, even though I believe it's only in the United States that SEC works and operates this way. All the other exchanges in the world, you can file the documents in PDF or in a Word file. You can just send them the email with those documents. You don't need to have that conversion done.
All right, so Jason, you're probably at the forefront of this new offering revolution. We talked a little bit about founders crowdfunding. So Reg CF went into effect May of last year. It has had limited results. A lot of what crowdfunding regulation CF tries to accomplish has actually, frankly, been done better by individual states with their own state rules. And so there's questions around something called fixing crowdfunding. There was a bill last year which didn't get signed called the Fixed Crowdfunding Act, which would have increased thresholds from 1 million to 5 million. But by and large, most people who are looking at the national crowdfunding exemption are doing it on their own. They're filling out their own forms. They'll go to someone like Steve to file the Reg CF form. That goes effective immediately. There's a 21-day waiting period before you can start offering, but you have to use a broker-dealer or a funding portal in order to affect those transactions, and those funding portals are liable for compliance with everything on the chart here that you see on the far left. And so if you don't have all of the boxes ticked, if somebody, Reg CF is the only exemption I'm aware of which tracks your investment from one deal to the next and will actually cap you off at a maximum amount per investor per year. So if you've fully invested in one deal, you can't go back and invest in another. Excuse me. So the next level up would be Reg A, which is the offering to the general public without full SEC registration of up to $50 million under the Tier 2 or $20 million under Tier 1. And I'll turn to Jason because the OTC has now made a big push in Reg A. We've seen other exchanges weigh in with their version of trying to uplist from a Reg A transaction to an exchange. And I guess, what do you advise clients that come in and ask you about Reg A? Should I do it? What are the main differences between that and a public offering if I should do an S1? What do you advise on those?
Well, we advise a lot. Certainly, the headline is I can raise $50 million cheaply and easily, right? That's the headline. That's what everybody got excited about. That's kind of what's on there. The second piece of that, which a lot of people forget, is you can't just raise, it's not just raising the money, but you're raising what are called freely tradable shares. So part of the interesting thing with Reg A Plus is that the shares are immediately freely tradable, right? So there's no restriction. It's not like a Reg D. And so one of the things that a lot of CEOs we talk to kind of gloss over, and a lot of the investment banks that advise and the lawyers that gloss over, is the what happens after you've raised the money, right? T+1 is you're now sitting on a share that's freely tradable. That doesn't necessarily mean there will be a public market, but the way the markets work, there could be. So you could wake up on a week after you've raised your money and you actually have a ticker symbol and you've got a share that's trading through nothing that you've done on your own. So I think it's important, and a lot of what we talk about with Reg A issuers is just remember that. Right? You can't decide that you want to be a private company. You can't decide that you want to restrict these shares. In the Reg A universe, the investor, there is that mechanism to have these shares be freely tradable. So then the next thing you talk about is the costs. And I think, we've all kind of talked about things that cost money in being public. Certainly Joan referenced, being on a national exchange, the costs of being a public company on a national exchange are expensive. One of the deals that was highly touted, the first one to go on the New York Stock Exchange, was Myomo. They raised $4.9 million using a Reg A plus Tier 2 and immediately went to the New York Stock Exchange, and the CEOs were excited. Who doesn't want to go ring a bell? And very sexy. But if you think about it, they raised $5 million. 2+ of it was actually spent just doing all the stuff that one has to do to be a public company on a national exchange. In addition to which, they're fully reporting now. The second you go on a national exchange, you become a fully reporting issuer. So all of the things that Reg A was trying to solve, companies being able to crowdfund investment, being able to have a freely tradable share where investors can buy and sell, being able to do it all in a way that was less expensive, also in a way where you could go back every year and raise $50 million. It says on Brian's chart here, once you go to a national exchange and become a fully SEC reporting company, you can no longer avail yourself of Reg A. That's something that a lot of CEOs don't know either, right? So the second you go to a national exchange and you're spending half of what you've raised, and then your ongoing cost and complexity when you're still an early stage growth business, are things that people don't really think about. You get to the I can raise some money and I can be on an exchange, and that's really sexy. And once the banker's made his money after he's advised you to do that, he walks away. He's made his money, he's gone. You're now the CEO of a public company with all of that liability, day in and day out, spending a lot of time, having a lot of committees, having a lot of things that you don't need to do. And that really wasn't what Reg A was designed to do. And so we spend, you want to be the company you are. You want to be able to raise money. You want to be able to raise money again and again and again. And you want to grow up, and you want to eventually be, to use a sponsor, American Airlines, right? You want to grow and become a great public company. But Reg A isn't the way to start. And we spend a lot of time educating issuers on that, because a year from now, the company that raises $5 million and whose stock price is tanking and who maybe didn't execute the way they were supposed to is still on the hook to be an NYSE reporting, SEC fully reporting company, and the management is now running through circles trying to figure out how to maintain that listing and not get kicked off an exchange. And nobody wants to be the company that's going down. You want to be the company that's going up. So I guess that's a long-winded answer to understand, and I think Joan said it, understand what it means to be a public company. There's a lot of bad actors in the small company space, and there's a lot of, we call them vultures, that will give you advice that behooves them but probably doesn't behoove you. Do your homework, talk to a lot of people, get some good advice, don't be blinded by the promises of money and bell ringings. Really know what it means to be a public company and be the company that you are.
Can I say one other thing? We had an interesting conversation backstage amongst all of us. Can you talk a bit about liquidity versus volume? Because I think it's really important, if you're going to operate in this space and raise capital under Reg A+, there's certain things you should not be seduced by. This is one of them.
Well, one other thing is, just to highlight what Jason said, they raised $4 million and they spent $2 million raising $4 million. Right, that's the most expensive capital raising we have. If it were
$4.9 million, they raised 4.9.
So, and I, with all due respect to the bankers who worked on that, I know several of them. They probably can't tell you what this company does, and so it's just startling to think that you could have a regulatory bubble that could start through this exemption. And you go out, you're on the, it's almost like a premature birth, really, to you're not ready, you don't have the capital to be a public company, and it's a liability disaster, because once you are a public company, you're subject to the heightened level of fraud. You're subject not to the intent standard, but to failure to file public offering, reports on a timely basis is a guaranteed shareholder suit, and those are always winners. So,
what's interesting is that they raised 4.9 million. They wanted to raise 20 or 30. So one of these trends that we're seeing last year when we all were talking about this, it was raise 50 million and then you can, whether you list on the OTC or one of the other exchanges, now you've got 50 million. The expectation was 50 million. Except that what we're seeing is that the expectations are coming way down. We've had several clients that had $4, $5, $8 million minimums. One of ours had a $13 million minimum. They didn't meet their minimum, and that was it. They had to give back all the money. We just had to do one of those 3 weeks ago. They did meet their minimum. Their offering period expired. They had to give the money back. So one of the things that we're seeing is that, and I don't know that this is necessarily a good thing, but that minimums are coming way down. I think I've seen more zero minimum offerings than I would have ever imagined. I don't know who's advising them, but we're seeing these minimums coming way down, and the pitch is this. And I've been on these calls where the pitch is being made, where look, let's bring the minimum down to 2 million, because when we hit 2 million, we can break escrow, and then we can get our syndicate. The broker will say, we can get the syndicate to participate, because then the on-ramp to the IPO is shorter. So we will help you raise 2 million, and then we will go to the syndicate, and we'll raise the rest. Well, the reality is that the syndicate might throw in another 2.9 million, but they don't put in 18 million, and then the broker will say, okay, let's close this, and now let's get this trading on the New York Stock Exchange, and then we will do a follow-on offering later because it's easier because you're already publicly traded. So the story is evolving significantly, and you as an entrepreneur that just want to build cool stuff, as soon as that happens and you buy into that story, you're now taking on a level of responsibility that you can't imagine. I mean, we were talking about this one CFO that was asking, well, what's the difference between registered and unregistered securities? And this is getting ready to be a publicly traded company. It's like, that's the wrong CFO. The CFO, this should not be the CFO. Yeah, they're a very responsible, highly profitable manufacturing company, but they don't have the right team.
And then once you're traded, any kind of follow-on that you do will be at a discount to your public price. So if you're a $5 stock, you probably can't get a deal done for over $4.50. And that's the reality at that point. Go ahead. You want to say something, Joan?
So, I mean, one of the things that people get seduced by, or that misunderstand, or don't understand, or just forget, because it, for whatever reason, there's a significant difference between volume and liquidity. And so it's interesting, we talk, and I don't want to pick on Myomo, they're actually nice guys, and I know a bunch of people that did the deal, but it's something to think about. And then there's Elio. So Elio was, when I was here last year, it was the first Reg A Plus deal that went public. They raised $17 million, 66,000 investors. The stock traded about 4,000 or 5,000 shares a day. And people came up to me last year and said, oh, that's a garbage deal, there's no liquidity. Now fast forward to Myomo, they placed 650,000 shares, and the thing in the first couple of weeks was trading millions of shares a day. I mean, the turnover was incredible. And everybody's saying, see how successful this is? Look at all the liquidity. And you had reasonably intelligent people that said Elio was a failure trading 4,000 a day, and Myomo was this huge success trading 20 million a day or whatever it was, 10 million a day. You have to understand the fundamentals of that. Elio was very liquid, right? A public market where market makers are standing ready to buy and sell securities, that's liquidity. They didn't have a lot of volume, but they didn't have a lot of volume because they had a lot of investors that bought that share that was crowdfunded that wanted to hold on to it. They were believers. And there weren't that many shares in circulation. So 4,000 shares a day was liquidity. You could buy and sell that freely the same way you could anything else. It just didn't have a lot of volume. Myomo, on the other hand, which only had 650,000 shares placed, plus or minus, that had all of that volume, what you were really looking at was the investment banks flipping that stock again and again and again and again and again. So a lot of volume and liquidity, but not really good volume. And if you look at where that stock has traded after all those folks have flipped out of the IPO, you're back down to a much more reasonable volume share price, but it's kind of tailed off significantly. And so, again, it's all about education. It's all about, like, everybody knows this stuff, but for some reason when you talk about listing on an exchange and investors, and people kind of forget basic math. So remember your basic math. If you have 5 million shares outstanding, you're not going to trade, hundreds of millions of shares a day. If you've got 10 million shares outstanding at $5 a share, Fidelity is not going to be able to come in and take a huge percentage. You're not going to get these large institutional investors. Remember your basic math when you're going public using Reg A.
So one thing on the chart here you see is the bank itself is a little bit schizophrenic. There are people who want to sell the transaction, and then there are people who want to make money off of trading and retail investing. And you have to recognize that as a company, many times you need independent advice. And you need to look at, okay, is this really going to benefit me? What are we going to look like 6 months from now when we're a $4 stock, we're struggling to make our Ks and Qs, and now there's pressure on us to make earnings when we weren't really an earnings-based model, we were a research model. And that's, now we're being comped by analysts who have us against a peer group of companies that are totally different from what we do, because nobody's so specialized to actually take the time to look at what we're doing. So we're on a grid with a lot of other companies, and it's not an analogous story. So I think that's a big lesson from this.
I'm just going to add, we're talking like all these negative things here. Reg A Plus is amazing. Right? The democratization of finance, the fact that you guys can all go out, for you entrepreneurs, and raise money, have freely tradable shares, up to 50 million a year. You can go back to the well. We just listed a great deal. It started as Keystone. It was a Reg A Plus deal. Keystone raised a significant amount of money. They were able to do an acquisition. They actually are going to pay a dividend. They acquired another company on QX. They've rebranded. They're now called Novum. That's the right way to do it. That was the way Reg A was intended. And they got great advice, and they had a lot of smart people working through it. Reg A Plus is a great way to do what it was intended to do, to allow early stage growth companies to be able to raise a significant amount of money, to be public companies, and to, what was capital raising intended? It's to bring the idea to the money. That's what this is. You can bring your idea to the money. It wasn't so bankers can flip stock and all these other things can happen. So I don't want to be negative on it. It's working when it's being done right, and when the entrepreneur takes the time and doesn't get bright lights, big cities.
So in the Reg A Plus listing on OTC, just to be clear, you don't have the quarterly reports, you have the semi-annual reports, but it's not a complete free ride. There is still a lot of infrastructure that goes into producing these reports and having qualified personnel, et cetera, right?
There is. It's not a free ride. And if you're on our top market, which is OTCQX, we actually still do require that you do a short form quarterly. So there is that additional level of disclosure that's not required under Reg A. But you're still a public company. It's just much less onerous. You're not required to have the 3 committees that we talked about. You're not required to be Sarbanes-Oxley compliant. So it just is a lighter touch way of being public. But there are still rules and regulations and requirements to meet those standards.
One of the things I wanted to touch on that we've said a couple times, and it's this whole concept of being able to engage the institutional investor. And there's a lot of conversation about, well, if I trade OTC, the institutions can invest, right, for whatever reasons, whether it's the blue sky laws or whatever. And I think that as entrepreneurs, you need to understand that regardless of the exchange that you list on, it's not going to matter to most institutional investors, because most institutions are going to have very specific requirements as to what sort of companies that you can invest in. So just because you trade on the New York Stock Exchange doesn't mean that an institution will be able to invest. Because most of them, unless you've got a market cap of $1 billion or more, will even be able to look at you. They won't take meetings with you. You won't fall and fit any of the criteria that are required in order for them to even consider you. So they've got cash flow requirements. In order for an institution to find you appealing, you may need to be around for a certain period of time. And so don't be lured by, I don't want to feel like I'm pitching Jason and the OTC markets, but don't be lured by the bell ringing because you think it's going to give you access to another group of investors. Because the reality is those investors aren't going to find you appealing probably for a very long time. And so what you want to do is make sure that you are looking at the right investors for your offering that are going to help you get to that point. And it's not going to be a Fidelity. It's not going to be a Fidelity for a very long time. Every once in a while, there may be a unicorn that pops up that does something extraordinary. But for the masses like us, we need to figure out who are the right investors to help us get to that next step, realizing that it might be 6 or 10 or 12 steps before we really should start thinking about the New York Stock Exchange.
Actually, in looking at this, the SEC did a study on, they've been looking at what's wrong with the small cap IPO market for years, and there's any number of theories, whether it's tick size or other things. But one of the things they found is for sub 500 million market cap companies, I think the number is something like 75% of the investment is the self-directed investor, right? It's not the institution. So that's really kind of the thought behind Reg A+, right? It's that self-directed, non-accredited investor. That's who really your natural shareholder base should be.
And the other thing that people should think about in regard to that is, and Ilya was a good example of this, and there's some other of the little cool car companies that probably fall into this category, where your investors are your customers, they're your fan base. And that's part of what makes crowdfunding work, is people feel a connection to whatever the business is. And usually, those people are what we like to call patient capital. They're not the people that are churning the stock. And Ilya was a good example of that. As you said, there wasn't a lot of volume of stock being traded because people invested for reasons that were important to them over and above true, I would call, investment analysis concerns. They had a connection to the product. They wanted to own the stock. They intended to hang on to it. So there's a certain element of that in Reg A+, and if you look at what's been successful with Reg A+, the majority of these offerings are not trading at all. Many of them are real estate offerings that have a structured redemption program with some limits, but it gives people some degree of liquidity. So although it created a freely tradable share, those shares are not freely trading on any particular market, but the issuer may offer a buyback program or redemption program. And those offerings have been pretty successful. There are a handful of real estate companies that are doing these $50 million offerings, ticking along with a whole bunch of happy investors. So it's important in this atmosphere to really, as an issuer, take a hard look at who you are, what you need at this stage, and what you have the resources to support, and to have a plan, and really be true to what you are about. Otherwise, you don't want to get in over your head, and you can see there are some examples out there of people that are swimming in deep water and probably barely keeping themselves afloat. It's just important to get good advice, to do some independent thinking, and make sure you understand what the capital is going to accomplish for you, and also to understand your responsibilities to your stakeholders, which, it's usually the employees, whoever owns founder shares, and whoever you have coming in as investors. Those are all stakeholders in your company. And that's one of the reasons why the Jobs Act has worked, because it allows people to connect with capital, hopefully at a lower cost, and do things in a particular way that suits smaller companies. But now we're seeing a little bit of a trend for people going to the sexy thing of ringing the bell. And it isn't necessarily going to serve your company well. I'm not saying it can't, because there are certainly situations where I would call that the exception, but it's almost like if you have a child that is really bright and does well in school, do you want to take that fourth grader and shove them up into high school? Is that really where they belong? And that's exactly what you see happening with some of these right to the exchange listing situations. It isn't necessarily where you want to be.
So you touched on the e-read point. Reg A is also being used for funds, so funds can now raise capital. We saw that with Fundrise that have done 3 $50 million REITs. They've raised them, and then we'll allocate them into real estate investments. It's a permanent capital vehicle. Realty Mogul has a similar product called the Mogul REIT that you may have heard about. The other thing is companies can also issue debt under Reg A. So we helped a company called Street Shares, which lends money to veteran-owned businesses and military family-owned businesses. And a lot of their veteran and defense group are not accredited investors. They have a Reg A product where people can buy notes that are recourse to the company. So they're basically bonds of Street Shares. They're called vet business bonds. And instead of being on a Reg A platform where you're buying interest in these loans, you can buy an interest in the company through these debt securities. So that's another way that Reg A has raised a significant amount of money. Another company that we just qualified, C-Note, does the same thing with community-based financial investment. So there are multiple avenues of investments here. Steve, any other thoughts around how investors are using Reg A and the IPO process?
No, I completely agree with Joanne. You're absolutely right. You know, the real estate companies, they're very successful in raising capital from the crowd, and also your followers, your clients, are the ones who become your shareholders. And that's what it's all about. Also, on a Reg A Plus, from the point of from the filing point, is the cost is tremendously, it's much cheaper, to file the documents instead of like being a 34 Act companies, because you get stuck with the Q's in a case, and not just the filing process, you also have to convert your financials into XBRL format, which is very expensive, and it adds to the cost tremendously. When it comes to a Reg A Plus, you do your offering, and these days it all can be done for a fixed rate. And there is no printing involved, which is also a very high cost when you do the IPOs in a regular way, through S1s. And then in terms of regulatory compliance, it's, semi-annual and annual reports in a plain HTML language, plus, current reports that you have to file.
Yeah, I mean, you see the IPO timeline here. It's a tremendous undertaking. There's certainly a middle ground, but if your equity deal is less than $10 million, you should really think hard about whether it's appropriate for you to list on an exchange where the costs are going to outweigh your resources. One final thing I'll mention is the SEC 2 weeks ago weighed in on ICOs and proclaimed that they are not currency, that they are likely securities because investors are buying them with investment intent. And so all of the coin offerings, everything else that you've been seeing where people have been raising capital under the basis that these aren't securities offerings, we don't have to comply with the securities laws. The SEC came out with something I've never seen before, which is a press release with a quote from the chairman of the SEC, the head of the Division of Enforcement, and the head of the Division of Corporation Finance. And all of them are in unanimous agreement that as investors are buying these for capital appreciation and not for legal tender, these are securities, and if you are making a market in these, you are likely operating an unlicensed securities exchange. And if you are selling these in a way that goes out to the public, you should do so under a registration statement or a Reg A Plus qualification statement. So again, everything we've learned in the last hour now applies to ICOs because the SEC has said so in the last 2 to 3 weeks. And so that sort of brings the whole thing full circle. We have time for, I think, one question. Yes?
That would mean that you'd probably get currency, you'd get securities capital gains treatment rather than currency capital gains treatment, or no word from the IRS?
No, so the IRS has not weighed in on that, but presumably these are securities and therefore they'd qualify under capital gain. Okay, I'd like to thank our panelists, everybody for joining us today, and look forward to furthering the conversation later on. So thanks everyone for their attention, and we'll turn it over to the next group now.